Introducing the 3-part options course with Hans Albrecht. Get access for free by scanning this QR code or clicking on the link in the description.
Greetings and welcome to Macro to Micro Options Power Hour. I'm Samantha LaDuc, founder of LaDucTrading.com, and I'm joined by Hans Albrecht, our options mentor extraordinaire, and we are talking all things earnings and election. So we're waiting patiently for the results of Meta. Happens to be Wednesday on October 30th. We've got Microsoft and Meta. We've already had Tesla and Google, and those plays have been very fruitful. We set this up for clients and then even reviewed it for Wednesday of last week before Tesla announced, and I had a particular interest that that bull risk reversal, which was buying the 250 calls and financing those with $200 puts, and that ended up going from 2 to 20. Hans has had a financed call spread on for Meta that he took some off because it was very, very successful. So we've got some things that are working, and then some things that we had to protect, like Eli Lilly into earnings today, which did in fact fall over and dragged all the GLP-1 or weight loss obesity drugs with it. It did bounce at a very key level, but as a trend long, that since 200, that is a particular stock, LLY, that I wanted clients to protect on the case of a downdraft. So far, so good. We are going to review some other earnings trades that are coming up. One in particular that I'm interested in is Square, and some election risk protection that I think needs to be considered. Even though gold and silver have been hot fire flames for all kinds of good macro reasons, I really want to talk about some protection into the election and FOMC and beyond. So let's have a look, Hans. What are you thinking right now for your earnings plays?
Well, so far so good on a few of the ones that we picked out here. We had the Meta, as you mentioned. I can see it's up. It must have come out. It's up maybe only $6 or $7. So that's that may be just in anticipation. I think, Samantha, you were saying typical.
Give it a few minutes. Yeah.
Give it a couple minutes. So people are buying it up a little bit. We had that nice pop this morning to 605, and that filled back in down on the day. So markedly nervous, talking about this for at least a week now. Every single pop results in a drop, and so we've been getting the pop and drop over and over again as people sort of get excited first thing in the morning, and then they go, oh, wait a minute, we've got huge earnings, we've got FOMC, we've got an election, we've got rates fall through the roof, we've got all these things kind of overhanging this desire to take part in this run to 6,000 that we talk about sometimes. That everybody, it's almost, I joked today, I said, I'm getting a little nervous because everywhere I look, everyone is going, oh, we're going to have the melt up into all. Yeah. It was a very kind of reasonable thing to assume. It's seasonally, we're going to get past all things in this week. Why not? Why shouldn't that happen? People are underweight. I'm going to show a chart in a little bit showing how underweight people are in technology, in Mag 7. So even though markets are hitting all-time highs, we're getting, we have to sort of say that the mags are, if anything, some of them are really kind of lagging. And that you don't say that. You haven't been able to say that very much over the last couple of years, but that speaks to a bit of a broadening out that's happening. And I think that's healthy overall. But we definitely have a few things going on into the next few days. And I joked today that my shoe shine boy, I don't have a shoe shine boy, but I said there's that old story about as soon as the shoe shine boy tells you that, starts recommending stocks to you, that's when we're hitting a market top. And so I was joking that, my dad's shoe shine boy mentioned to him that he thinks we're going to get this melt up into the end of the year. So I thought, should we start getting a little bit nervous about this when, this is the
always
sort of prevailing attitude?
Yeah, always. I put that as well in some market thoughts for clients, that we really do have seasonality in our as a tailwind. We definitely have a bunch of VIX calls that will likely get, as you have mentioned, a VIX trade in particular on IV crush post-election when we get through the big Mag 7 tech reporting and FOMC and election. And of course, this week we just had the QRA, which was Yellen's quarterly refinancing announcement, which has a lot to do with how to finance this fiscal deficit that we keep growing in the US Congress. But we definitely don't have particular one event, we have a slew of them. So it's intense. There's a lot of intensity right now on trying to position just through this 2-week gauntlet and then into year end. But yeah, you've got some charts to show on volatility and also kind of investment positioning. I still see this very, very one more high type of play. I hate that it's also become consensus. That's typically when the rug starts to get pulled. And yet, Meta, for example, selling off and gets popped right back up. There is an invisible hand. SMCI this afternoon had an announcement this morning, actually, that their auditors left. So Ernst & Young are like, we're out. We can't rely on the management. SMCI is the third largest customer of NVIDIA. NVIDIA isn't skipping a beat, and it still has unrelenting call volume coming in much higher strikes, in much later dated positions of size. So it's very hard for the market to sell off without NVIDIA.
Yeah.
In a nutshell.
It's incredible, and we talked about it in the internal members meeting yesterday. So many people own NVIDIA, and bigger than 5 different G7 country stock market valuations. It's 18% of of the market is owned by foreigners, and that means they own a whole bunch of NVIDIA everywhere. So I think even once we get past this, and so I'm wondering if how to play all.
Hans, your microphone is going in and out. I don't know if this is the recording or if it might be your microphone, but just to let you know.
Oh, okay. Thank you. Let me just check that audio quickly. So I wonder how that plays into things, because we're going to get past these very big, the biggest events of the year, as we keep saying over the last couple of months. And then we're going to eventually get to this all important NVIDIA number. And we're sort of seeing in the semiconductor area that we saw AMD really hit the skids today. And we've seen, of course, there's the SMCI, there's the ASML. Micron isn't that far from its sort of 4-month lows, 3-4-month lows. And I don't know who's left. I sort of thought maybe NVIDIA is the last man standing, but we've got Broadcom as well. So those are kind of emerging as those. We talked about this bifurcation in semiconductors that might result over time, where all boats are not lifted. We have to focus more, and there's this incredible pressure being put on NVIDIA now. As you said, it isn't missing a beat. I mean, it just came right back again today, and maybe that speaks to they are that prime picks and shovel maker in the area of semis and AI and really the kind of at the very forefront. Maybe they do suck up all that money. And it's justified, but boy, that's a lot of pressure on that stock. So I can see vol getting crushed, and we're going to talk about a couple strategies in a moment to take advantage of that. But in a couple of weeks, we might be in a similar situation again, where the market is again on edge because of this incredible importance that we've placed.
So what are some of the positions that you have right now that are doing well in this kind of euphoric backdrop, and what is right now maybe sucking wind? I can tell you that you asked about a few on the energy front, and on my side, they just haven't triggered yet. Not even close. But the tech space of software and Mag 7 have obviously made up for it. So what's working for you? What's not?
Well, a couple of the big caps. So I've been really focused on Meta. I like Microsoft as well. I think it has the potential to break out of this big sort of pennant pattern. I like Amazon. I think it's acting very well as well. I think it's a reasonable valuation, 35, 36 times forward earnings. I think that's actually not that bad for a stock that's now number 3 in ads. So we had Google. So that was a focus on ads. That's what initially helped to push Meta up over 600 this morning. And we talked about that 600 call wall last week. I said, the call wall can be important. So I've got this call wall here. Around that 600 level. And generally on earnings, you can blast through the call wall, like the Kool-Aid man smashing through the wall. So that generally call wall, if there's that organic flow, it shouldn't matter as much. But maybe it did matter again today, because we popped over 605. And I don't know where it's trading now, but if it doesn't have enough gas in it to get past that 600, and that would be kind of interesting, because a lot of pressures. It's been priced for perfection a little bit here. I had this trade on that we talked about in last week's show. There was a Meta trade which I took off half of because we got a big move. I put it on around 565, and my theory was that we're looking at about a $50 move on earnings, and that would take us up to around 610, 615. And we kind of got to 595 in a hurry. So I said, well, I'm not going to look a gift horse in the mouth. And I took off half that position. And I think that was right here. I said, oh, I'm going to take off half the structure. So I paid $1.25 for it and sold half of it at 13.40. And then this morning it rallied back towards 600 and I took off the other half at 14.50. So in at 1.25, out at 14.50. That was a good trade. I mean, you don't often get those quick moves like that, but it was hard for me to stay in. But what I did was I said, look, I don't want to be out of this because it's one of my favorite names. So I took the whatever it is on, you know, what's my average? 14 less $1.25. So let's say my average is 12.50. I took $2 of that and put it into this butterfly here. So I bought the 610, 630, 650 for a couple dollars so that I maintain a little bit of upside. Now, if it goes down, I'm going to sacrifice a couple bucks. And that's important when you're trading these butterflies. The thing is, a butterfly, if you place it too far into the distance, isn't really going to give you bang for your buck, right? It's going to look good on paper. You're going to say, wow, I don't have to pay much for this. And I'm looking at this big, beautiful tent that you can kind of see on your software. But you don't get there until you get close to expiry. And so they're a little deceiving in that way. You kind of have to play them a lot of the time nearer term because you want this to resolve itself. And you want that Vega crush, which means for everybody out there, the Vega crush is you want exposure to short volatility. And as we know, we go into earnings and option prices get very, very expensive. And you're partially playing that crush. I don't know what's happening after hours because I haven't seen the stock, but the way that this butterfly is going to pay off is if we get up past that 610 level. I mean, we can get close to there and I might get a little bit of play out of it if because it's got about a week left in it. But for now, that was kind of the play, like a big win and then sacrificing a little bit of that to see if I could play a little bit more of a move into a stock that got a little bit maybe ahead of itself, even though, of course, long term, I sort of like that thing. I don't know what you see on the charts, Samantha, for Meta, but it's sort of in uncharted territory. So it's probably a little bit tough to say.
It's a beast. I mean, really, until we have concentration risk unwind, until we have a macro trigger to interrupt the bullish flows, the focus has been really clear in AI this, AI that, and Meta is, front and center. So anything above, believe it or not, this is so far away. But I mean, it's 523 is monthly support, and the mean is 500. So this is, printing 578 after hours. It's still in trend. Nothing is upsetting so far this dip. I know you're focused on a shorter duration, but the point is, big picture, this thing is still very supported. So I'm not worried about earnings right now on these Mag 7 plays until we have a macro reason for an unwind. So they're still going to get supported. That's it. It's kind of tough to be short when the breadth continues to expand, when underneath the net buying versus selling, it's just they're not stepping in and selling. So realistically, until we get a macro trigger, interest rates 10-year above 4.4 that sticks that landing, or it falls below 3.6%, we're still in an equity sweet spot for yields. And with oil falling, it honestly has been a consumer stimulus. So there really isn't a lot right now on yen carry trade or FX blowups. Escalations geopolitically have calmed down. So from a macro standpoint, we're still really waiting for a trigger. The election will obviously dictate who makes the policies, and policies dictate price. And until then, the market is just climbing that wall of worry.
It's bouncing back from every small sell-off that it sees. Now, if we get to that point, and I think macro just has to be on your mind right now, earnings, but also macro, because that's part of what I think is kind of what we think is behind these high levels of volatility, right? I joked this morning again that I think VIX is a 12 wearing a 20 costume, right? It's kind of almost this Halloween trick that the VIX is playing on us. It's really acting like, you and I talked about this the other day. realized movement, which is what the market is actually doing in terms of movement, is about a third of what the VIX is indicating on a short-term basis. On a third, about half. The VIX is priced beyond all sort of logic in terms of what the market is actually doing. It's not volatile. This is not a volatile market, but we have this rates vol that is super, super high. And I saw this here. I don't know what you think of this, but this 10-year yield versus Trump odds. So yeah, I mean, neither candidate is exactly a slouch on the spending side, but still they want to spend lots of money. So I'm not sure how that equation works. We're not gonna tax anybody, and we're gonna lower taxes. It's gonna be party time, and money gonna. So I think some of the nervousness in rates, which you're alluding to, if we start to push a little higher, that's got to start making stocks nervous. We're already at that point where we're just kind of pushing our luck, and maybe we need to come back down a little bit, but I don't know if that's going to happen with the way that this chart is following the Trump odds. It's very interesting.
Well, we've got FOMC next week, so some of this is just really positioning, and this is one of the things that I mentioned on September 18th, which was FOMC date before they cut 50 basis points, is that we were simply positioned to reverse, and bonds would get sold. They had been bid into, and yields were very low, hitting that 3.6%. It was a reversion trade set up on positioning that had also all that recession risk kind of pulled out as the Fed eased aggressively. So now we've gone from, oversold to overbought in the period of a month plus, and now we're heading into the next FOMC meeting, because there wasn't one in October, and we're really just rolling back over again. So we're doing a ping pong, but that's actually that range bound action in dollar and yields, if you kind of zoom out, which I like to do, right, is just very much still in the sweet spot. We have to break below 3.6% in the 10-year or break above the 4.4% in the 10-year in order for equities to get nervous again. That's my baseline bet. So make hay while the sun shines. Don't worry about the yields until they get outside of that comfort range.
That super strong ADP number is not going to help, right? I mean, that's going to sort of give the Fed a little bit of pause and sort of go, well, I don't know. So maybe that keeps rate vol a little bit elevated because, on the one hand, the market doesn't want inflation, but on the other hand, it wants rates to come down. But I'm not sure you can have everything. You can't have it all.
Yeah, market does love inflation. This is inflationary for assets. It's inflationary for homes. This is very much a wealth builder. I mean, this whole market is a wealth effect. They do like inflation, and it unfortunately doesn't last, historically speaking. We will go into another, disinflation or deflationary period. But right now, again, make hay while the sun shines. And on top of that, we've got the AI theme not going away. The SoftBank CEO, very well known, came out, at a Saudi conference and said he sees a $9 trillion build out in data centers by, year 2035. But the picture is they're still really drinking this elixir. Some of it is overestimated, but the point is they're still very excited about this and pulling forward all that growth. And of course, it's kind of like a client mentioned this analog, which was great. He said, you know what, in San Francisco in the gold mining days, there was so much, fake gold, right? But there was also a whole bunch of gold to be mined. So it was kind of the combo deal where we have to filter the fake gold from the real. And that's what we try to do every single day. Okay, so I want to just quick, because it occurs to me that
okay, let's keep moving. So here's your larger backdrop. So we're in this kind of positive gamma situation where basically that means everyone's kind of hammering the short-term volatility. They're selling calls, they're selling puts. Mostly, this would concern calls a little bit more as they create all this gamma. That means dealers are getting long a whole bunch of options, and that reduces volatility. So here we are. And we see it. We've been feeling it since before the JPM caller. We've been feeling this sense that markets cannot get going to the downside, and they're sort of making a little bit of progress to the upside, but really not getting anywhere in a big way. So if we get below a certain level here, then maybe we get into a period where we don't have all that gamma support, and we can maybe have a gamma profile that acts as a bit of an accelerant, as they call it here. It can, when dealers don't have stock back, they may have they may have to sell into sell-offs, then that can create a little bit of a, again, what we always talk about, which is volatility clustering. Either it stays very, very low, or all hell breaks loose. And so, and then up here too, if we start to just to move up into towards 6,000, we can actually even melt up even more strongly potentially. So this is that gamma backdrop. Take that with a grain of salt, because that profile changes all the time. But you know, the fact is, markets tend to do okay seasonally from here. We've got these corporate buybacks that have started again, and so here we are, kind of nervous about some big events, but feeling that the market wants to go up. So, what else have we got here? Well, let's talk about yeah, go ahead.
No, I was just going to say, some of the identification kind of guardrails in this have been the elevated volatility that we have talked about. And you had mentioned you were seriously considering putting on a VIX crush trade. Have you profiled that yet? Have you put that together, given all the things that you've just talked about, where, you know, downside hedges that have been bid up will get unwound just on the resolution of all these events over the next 2 weeks? We've got the corporate buybacks that are kicking in. We've got basically a whole bunch of systematic buying that happens also in the CTA world. I don't even know. We've covered a whole bunch of stuff. Basically, this overhedging FOMO is what you have just kind of profiled. What's a VIX trade that would capture some of that release?
Yeah, and so this is what I'm sort of thinking these days. And we've been talking about upside VIX butterflies for a while. We had a couple of them hit nicely. October did really well. November kind of not as effective, but you know, as a hedge, it sort of does what it does. When you win on those, you're kind of winning, but you're not happy that you're losing on your stocks. It's been a weird period where you've been making on hedge stocks recently. So we've got this sort of very interesting sort of backdrop where is this volatility crush on the horizon? And so all roads are kind of pointing towards this being a fact. So typically after elections, now we're going to put aside 2008 because we did have a persistence of vol into that kind of strange period. Typically after an election, you do get the market kind of grinding a few percent higher over the next period. And what that usually means is that you get a VIX that grinds lower, and it usually bottoms out around 8 to 10 days following the election. Now we've got FOMC that's going to maybe throw of in there as well, but typically what that's going to be, what you want is you want something that's going to kind of drip, because you're going to get that initial crush, but then it's probably going to continue down, and we'll see. I mean, again, I mentioned the NVIDIA, and at some point, market's going to go, hey, wait a minute, this is an important event as well. So we'll see how that plays out. 2000 was a little bit weird. So this is where this downside crush may not work as well, because remember, we had the contested election, and we had the whole Florida debacle and the hanging chads and pushing, you know, in the old days, you're pushing through that little hole, but if you didn't push all of the round piece of paper all the way through, it was hanging on there. And so there was all this drama for an election that eventually was decided. Crazy, all those people, and it came down to a few votes. So there is the possibility here, as we know, that if we don't get a decisive sort of election result, that vol may not get crushed quite as much. But one thing you can do, and so this is the VIX futures curve right now. So this is basically, you don't have to understand this too much, but it's just a sign of kind of, it's not a happy picture of how things are looking. So this echoes what we're seeing in rates, vol, and all these other things that we constantly talk about. Now, what you can do in a situation like this is you can sort of assume that, look, the VIX is probably going to come down from about 19, where it is right now, to probably 15-ish. Oh, we closed pretty high today, 2035. So we've really been hugging that 20 level, which has been frustrating to people thinking that vols should be coming down. But with these big events, it's waiting, but it can happen very swiftly, right? It happens slowly and then quickly. So suddenly we're going to see this crush come in, probably following FOMC, maybe after. Usually doesn't happen exactly when people expect it to. Sometimes comes a day early. what you can do with something like this is you can pick, say, a November 20. I don't like to get into the weeklies. They're very illiquid. So you want to pick something like a November regular expiry. Now, remember, when you're trading VIX, the VIX options on the November options are trading based on an underlying that is the November future. So VIX is a little weird, right? If it's November, if it's Apple, it doesn't matter what you're trading. November, December, April of next year, they all relate to Apple. With the VIX, it's a bit more nuanced. You're trading options on an actual future. So this is beholden to what the November VIX future is doing. And the November VIX future is trying to figure out where the VIX is going to be on November expiry. And where the VIX is on November expiry is the VIX looking ahead 30 days towards eggnog. So it's going to be looking at a period of calm. We're going to be most of them, we're going to be past all this crazy stuff going on. And so this is where I would kind of target. So I would think like a 19, you buy the 19 and you do a butterfly. So you're going to sell a couple of the 16s, and then maybe that protect yourself to the downside by buying a, say, like a 13. All our expiries on here. We're going to buy a 13 down here. And so what this is going to look like is this lovely tent that I put on Meta, that I was thinking of putting on Microsoft as well. And it's going to give you this profile. Now, let me talk about how this works. So here we are up around 20. The idea is that we get this big VIX crush down into 16. Now, the VIX itself isn't as important as the November future because the VIX options are based on the future. So what we're really looking for is a pullback in that November future. And I think you can reasonably expect that future to get sort of in the 14.5 to 15.5 range. Maybe 15. Now, under extreme volatility crush circumstances, if we didn't have this big, crazy vol situation we've been in since early August, which has been sort of persistent high levels of VIX, high levels of fear based on what happened in August, and then again in early September, we had, I don't know what's happened on, to the risk budgets of desks and the people who got hurt and, risk managers who said, listen, you've got to put on certain positions to protect yourselves. Or not have on, difficult positions, that maybe has put people in a situation where volatility has the potential not to get crazy low. So under normal circumstances, I would say a VIX of 13 would not be out of the question over the next few weeks, because as you get past all this stuff and look towards eggnog and Christmas trees and all that great stuff, the VIX can really, really go further than you think to the downside. Now, my guess is it just kind of hangs in there a little bit. So the November is going to play the direction. So butterfly, what a butterfly is nice for is both direction and short. And very important thing. That's actually why I was going to talk about McDonald's. Maybe I'll do that afterwards to give you another example of how this works. You've got some negative Vega exposure. So what that means is we know that there's going to be a direction to VIX futures. Hopefully they're going to go down. But there's also going to be this sort of Vega exposure that we call it. So effectively, you're going to have a nice drop, and it's really more pronounced in something like a McDonald's. But you're going to get this this ability for the VIX to kind of come into an area. And then remember, I mentioned drip, drip, drip. So it might get into sort of 16.5 right off the bat, and then just kind of drip slowly as we climb a little bit of a wall of fear, as I like to talk about. So that's kind of the play there. Now, you could also, if you thought, look, I think this is a nice play. If you think the election is going to be relatively decided and tidy, which I think is something you have to decide for yourself, then I think this is a good play. If you think that it could be a little bit prolonged, then we're going to see that play out. The VIX isn't going to drop very much. And then you might have to roll into a December kind of structure and figure, okay, this is going to take some time to sort out. I'm going to take maybe a little bit of a hit on my November and then roll into December. If we end up with a 2000 type situation where volatility basically stayed high for the next 10 days. So this is kind of what we're looking at. But with a shorter term structure, as I mentioned earlier on the meta, I think it was, you're going to get the bang for your buck because it's a shorter term structure. If you put on a December right now, you're going to get frustrated. The VIX is going to go down and you're going to go, why didn't I make any money? Well, the reason you're not making any money with a December fly is because flies really benefit from those last couple of weeks of their lifespan. So you're going to get this wonderful call where I called it, VIX went down and I barely made any money. And maybe you're going to even give it enough time for it to move outside of the tent, which will be really frustrating when you called the crush on volatility and you didn't make any money at all. So you probably want to stick to that November 20 expiry, and we'll see what happens next week.
All right, so now let's do the McDonald's, because that's one that we are currently in, and it's still falling, but needs time to reach ultimately that kind of 279.50, 280.
It needs time, and
It does.
that is, again, what we're talking about here. Remember, the fly, which is what we put on a 295, 280, 265 fly. Now, this was after the E. coli event. And so the chart had already dropped down through this channel here. So we sort of went boom. I looked at it. I said, okay, earnings are coming. And this was exactly what I said. I said, I don't think we're going to get very far through 300. We've got this nice, where's my little wall here? I had this pretty little McDonald's wall. Oh, I don't have it on my chart here, but there was a wall at 300. And I thought we're going to have some trouble getting through there, even on earnings. And that's exactly what happened. I'm kind of scaring myself with this one here, but we bounced off the 300 2-3 times. Earnings came out. We came above 300 and we filled right back in. It was just too much. And I said, there's the news headline risk. There's the call wall. There's the breaking down of a stock that had had a pretty good run. It's just going to be hard unless those earnings are absolutely spectacular, but I was willing to take that chance. So I put on this downside fly and I took off half for about 45%. And I took off the other half today, actually, for, I can't remember what it was, but overall it was around 43%, which is good for a fly.
Yep.
Occasionally you're going to put on a fly and you're going to lose your money. So, I'm bragging about 43%, but you're going to have a few stinkers in there too, right? That's kind of the nature of the fly. But this was a good one, and it was nice to see a plan come together. But again, what I wanted to emphasize here is with these flies, you are getting exposure to, number one, a little bit of direction. So I said, okay, we're going to maybe sit around 300, but we're going to probably start to drift down. What I did was I said, look, I think we're going to drift down. And I wasn't so right on that. We did go from 300 to 292, and that's when I took off half the position. So I made sort of a quick win in a couple days. That was the delta directional benefit. But then the stock came sort of back towards 300. But guess what? I was still making money around 297, 296. Why is that? Because I had this Vega exposure. So when you do things smartly and you layer the various forms of edge, so that could be chart edge, which means that you're calling a direction. It could be, or a non-direction, or a lack of direction. And you're talking about using volatility edge, which is, I think the volatility is too high. So let me show you where McDonald's volatility was. Here we are, almost the percentile of the range on McDonald's option pricing. So for me, that meant nice exposure to volatility coming down. Sure, it could keep going up, but there's a very good chance that it's going to come down. And sure enough, it has collapsed completely over the last 5 or 6 days. And that was my other benefit. So I didn't have to get everything right. I was a little bit right on direction, but I was also right on volatility direction. So I in a sense, half the position won from delta, which is direction, and half the position won from a collapse of volatility because I had that nice negative Vega exposure. So that's kind of a way for folks to think about things. Always think of direction. Of course, check your chart, but think of volatility. And I mentioned that client last, the stock dropped $10 and her puts didn't go up. Volatility was too high. And in this kind of market where vols are high everywhere, these are the sort of structures that have been working.
Excellent. Speaking of questions out there, because I don't have any on that, this is something that we've reviewed because it's great education. Does anyone have a particular trade they want sized up technically or via options, or any kind of macro trends that you're in right now that you're looking to protect? One, of course, that has been hot fire flames is gold and silver for all kinds of macro reasons. But as we get into election risk, there is probably some really good reason to protect those very long and very strong, meaning large positions that some folks have. I know we've talked about that a little bit. Some of the advice has been rolling out those directional bets in time, just to manage the potential volatility in the next 2 weeks. Any other advice on that angle?
Well, I really like for your silver holders. I know you have a lot of members that have done very well in the silver trade. That was a great call earlier in the year. Now, the interesting thing about the silver and gold complex and Bitcoin and and a number of these sort of safe haven type things is you get kind of funky skew. And when I say skew, I mean how expensive are puts relative to calls and vice versa? How do they relate to each other? And a lot of the times it's not as pronounced right now, but a lot of the times in silver, in gold, because people kind of scramble to buy those upside calls when silver and gold are doing well, they want to take part in that explosive upside. That'll happen in a GME rather, not GMC, GME, another one, anything that's kind of in play or maybe in the process of being squeezed, a short squeeze, a gamma squeeze, you'll see that upside skew really take off. And so in those products, you often get a nice skew structure, which is good for people who want to protect a position like SLV, because you can sell the call for a nice price, a nice level of implied volatility, and you can use that premium to buy a downside put spread, for example. So we call that a put spread caller. And it's really not that complicated. That's something anybody can look into. Very, very simple. You just look for, I generally like to position myself at the sort of 2 to 3 month duration for something like that. So I'd be looking at maybe a December, because if you position yourself too close, you may not get the sort of reactivity out of options that are out of the money that you were hoping for, right? So if an option expires tomorrow, your $10 out of the money put isn't going to care about a move until the stock really starts moving down. You want something with a bit more reactivity, with a bit more sort of kind of convection. So down, you want your puts to really kick in. You want that put spread to make protect. So I would be personally, and especially going into these big events, if you're up a lot of money, don't be afraid to collar these positions. It's a great sleep at night strategy because and you can often put these things on for no cost. So it's a bit like we talk about our financed fund plays, which are selling the downside expensive options to buy that upside. And I love that play as well, because your volatility is, in your favor. You're the casino in that case. With a caller, you're not getting the edge necessarily if you're doing that on the S&P. You're definitely not. You're selling cheap to buy an expensive put. But in silver, gold, and some of these things, you can do that for a favorable level of pricing. And that's what I really like in those areas. So if you're nervous, and I notice gold's still doing well. I sold mine out 2 days, kind of irritated, but it just keeps going.
It has been a beast. All right. So you prefer selling calls in the form of a collar against a core position, whether it's stock or options, further 2 to 3 months out, versus putting on any put or put spread product for a short duration, 2 to 3 weeks out. In a nutshell?
Yeah, I think so. I mean, you could just buy that put spread. So let's say, for example, you're up a bunch of money. So when I'm up a bunch of money on something, I don't mind sacrificing a little bit of that. So under normal circumstances, I might say, well, I want a caller that's costless. I want to sell a call for $5 and I want to buy a downside put spread, a bear put spread for about $5, right? I don't want to spend any money there. I want to get 5, I want to spend it on the puts, and I'm happy. If I'm up a whole bunch of money, and I did this on Baba last month, I said, I'm up a whole bunch of money on Jeffrey got me into that trade. I read his thing on Baba and I was like, how do I not own this thing? I've been thinking about it. So he got me into that. I thank him for that. So it ran up about $30 for me. And I said, I'm up so much money on it. I'm going to put the collar on, but I'm going to bring that put in a bit closer to where it's really useful to me. So the stock was only trading at 115. I bought the 110 put. I sold some upper calls. So I got a little bit more aggressive on that put side. And that cost me a little bit of money. I think it cost me $1.85 or something, or $2. But I was okay with that because I just made 30. So I wanted something that was going to truly protect me. I didn't want a 90 strike put for no money because it's not going to do much good for me. So what you can do when you're up a bunch of money, don't be afraid to spend a little money. Don't be a cheapskate. Get out there, spend a little money, and protect that position, particularly if you're a little bit nervous and you're heading into the end of the year. You've had a fantastic trade for 8 months. Spend a little.
What did you do for time frame though? Was it a multi-week or multi-month when you said you sold the calls against BABA and you bought some puts and they were close relatively, $10 wide? Do you remember how far out you went?
I went December. I went December. And then the nice thing about that, let me tell you how that worked out. And this is when I remember an old mentor of mine said, you know what, it's nice. Some of these multi-leg strategies are sometimes kind of fun because you always have a piece that you can play with. So the BABA got down under 100 and I tweeted about it. I said, you know what, if it gets under 100, I'm going to take off this collar. And it hit 96 and I didn't take it off. And it rallied a couple of dollars, and that was it. I sold out my put, and I had the call as well. I was short the call. So a day later, I said, okay, I don't need this call anymore. But I looked out to where it was trading. It was trading about 40 cents. I was going to have to buy it back, and I was able to buy a 130.45 call spread for about the same price as I was going to pay for just buying the 155 or 150 that I was short. So instead of just buying back that short call, always look to see if there's a more interesting structure that can actually give you a little bit more punch to the upside. So if I don't know if China's going to have another run like that, probably not. But if it does, and BABA just gets going, it's a super cheap stock, anything can happen. If it gets going, I'm actually going to turn that upside, this particular trade, into a fantastic upside potential type of play by getting a little bit creative with buying back those options. If you're going to buy back an option for 40 cents, maybe you can put on a nice $10 spread for 60 cents. For a little bit more money, you can actually have a very nice, more reactive, closer to where you're trading call spread. So you always play around with it.
And you went out how far in time for the higher out of the money call spread? Like what span of months?
Same December.
Okay.
So it was all in December. Yeah.
Okay.
Exactly.
Yeah. On China, we probably won't get another hit until they come out with fiscal, and they're promising an announcement next Friday, but we don't know what will it constitute because they also made some of the fiscal dependent on whether or not Trump gets elected, which is bizarre. But anyway, we'll see how that runs. We run down the clock on the election into Friday, but China may also announce some 10 trillion in yuan, that is, in a potential fiscal stimulus, which was not part and parcel of the bazooka that they announced a month ago. All right. So any other, any questions on particular trades? I think we talked about Square a little bit. You're looking that up right now?
Yeah, I'm looking this up. Wow, what a beautiful sort of position here. Broke out of that level there. Retested. Yeah, I've been kind of looking at this. I did own it back in the 60s. I sold some covered calls, and then eventually I just got rid of the position. I just wasn't sure how I felt about it, but you kind of feel, I don't want to say it, but you know, it's looking kind of interesting. I hate to say it, but ARK is, I almost wonder if, I don't know why it's acting well, because it should act well in a real low rate environment where nobody cares about money anymore.
It had Tesla respond obviously to earnings, and it has a big percentage of its stock is in Tesla, and then in a whole bunch of other kind of biotech, regenerative, whatever. It doesn't matter. The point is, yes, it's not one I typically look at, but I think that's one of the reasons why it has moved up a little bit.
Well, and that's the interesting thing. We're seeing the Reddits go. We're seeing, I think things like Zoom might go for another run. I think there's some interesting kind of plays that people have forgotten about for a little while, and maybe Square is one of them. I mean, we got into the 260s, 270s in 2001. Sure, that was 400 times earnings, but it's an interesting one. If it can get through here, I'd love to hear Nell's. Nell's our chart master at LaDuc. I'd love to hear his view on how this looks, but it's setting up quite nicely. The volatility, I mean, you could, if I look out on something like this, I wouldn't play anything super short term.
No, no, this is a bottom fishing play at best. And it does have some Bitcoin on the balance sheet, which is one of the reasons why folks are looking at it again. But mostly it has just gone sideways for 3 straight years after selling
Yeah.
off violently from 290 to basically 29. So it's one of those, yes, feeder plays that potentially is just can get chased into some higher levels and then potentially higher depending on short interest and the like. I just noticed Carvana had another stellar earnings, 251. Everyone had left that for dead. And that was one literally in 2022. I talked about at the end of and the beginning of 2023, Apollo came in with some debt financing. The CEO and his father came in and bought shares on the low, which was like $5. It's now 205. No, sorry, 250. The point is that these can continue higher after a long period of basing. And I think Square is starting to look very much like PayPal or Docu. Some things that we've gone over, right? The past few weeks we've been doing this. We kind of pick one play that is what I call affectionately a bottom fishing play. And Square's mine right now.
Yeah, that's an look at that Carvana, 130 to 207. I mean, that's just crazy.
It's
Yeah,
250 after hours right now. It's 253. So
oh,
yeah, so I'm not saying Square is going to do that, but there are some, like you liked SoFi, and this is one that you are very fond of recently, and you own Uber, so Uber has earnings. So those are three just to kind of, I guess, wrap up Square,
yeah.
SoFi, and Uber. What are you doing with those, if anything?
Well, SoFi had a nice finance play that I took off around 11:30, and it came back down after the earnings. I was a little bit nervous, and I wanted to take some profits off the table. It came back down into the nines, and I sort of kicked myself for not owning it. So I sold some puts up in here, but a small position. So it's kind of just to get me involved again. I feel like it is one of those potential melt up kind of plays. I like Hood and SoFi. Just I think I'm a little bit more fond of Hood just because I feel like they've got really great management. They're figuring out what people want to see. You know, you can start. Now you can bet on Harris Trump. You're very progressive, forward thinking, and to me, I like to invest in good management. If I see good decisions, I see people trying to figure out new revenue streams versus some old dusty Fidelity type entity, that kind of gets me a little bit excited. I know that they are going to have things that are great in the future on top of what they're already doing. So these stocks are not cheap, but you always have to keep that sort of, well, what does the future look like? That's a very important element. I mean, that's important on Tesla as well and other things, but with some of these stocks, it's very important because they're in a very evolving area of digital finance, and you want to feel like they're going to be finding new revenue streams everywhere they look. So on the Hood, I'm basically just short some calls against this. It's kind of in my cash machine strategy, which is I just want to generate as much premium as I can. So I get a little bit more aggressive on these. And in terms of the strike price, I get a little bit closer to where the stock is trading when I do these trades. And you might think that's a bit counterintuitive because if you really like the stock, you should give yourself a little bit more upside. And that's fine, but this is in a particular strategy that really just focuses on grabbing as much premium as possible in a stock that's quite volatile. So when I sold these 26 calls, I think the stock was 26.30 and I got 260 for them. That's a lot of premium. You're getting a gigantic premium. So that's nice. In that case. And then if the earnings, which are coming out, are really great, well, that's fine. I'll just roll them into a new one and we'll just keep playing that game of grabbing as much premium as you can. Now, on the Uber side of things, and I always like to finish with a couple of the tried and true strategies, covered calls, cash secured puts. So we've got earnings coming out soon on Uber. I'm short some 83 calls, which are down. I sold them at $2. They're down to about $1. I may have to cover those because I don't like selling into earnings typically in this part of my portfolio. So I may have to just grab what I've got, which is about a 50% capture on those calls, which is fine. And then we'll just play that upside, and then we'll figure out what Uber wants to do after that. Very nice kind of bounce off of here. As you know, I'm a big fan. Anything can happen on earnings, and we'll deal with it when the time comes. And then we've got our Palo Alto as well. You asked me a couple of weeks ago, you said, well, why did you sell the November one? Well, I said, that's before earnings. So I sold the 390s at about $7 or something like that. They're down to nothing. So I bought them back, and we're just going to ride this thing again. So the way that I do things, I think there's a time that you trade options, and there's a time you just let the stock do the work for you. And we don't know what the future holds, but quality will eventually work out. As long as, you can get one or two wrong here and there, but as long as you are sort of allocated properly according to your risk tolerance and, reasonable sizing of positions, like I wouldn't have 50% of my portfolio in an Uber or Apollo. But over time, quality is going to play out.
Excellent. Well, I am very glad that we could kind of go through some of the earning plays that were recaps and then look ahead to the Uber for you, which is already core position, Square for me. I am really just patient that a lot of the stuff that is bottom fishing is typically going to be pushed back down, unfortunately. But there are some rare exceptions, and I like to have that in play once it has really cleared some key monthly hurdles, like PayPal finally got up off the bottom and has stayed firmly above 70. Even after earnings 2 days ago, it's still digesting above 76. But the point is, this is very constructive for a move higher in some of these oversold software plays. While Mag 7 still delights, right? So we still have to go where it's, it's meatiest. And in fact, I have a Mag 7 ratio that I use as an intermarket tell, and it's pushing higher. I have a particular level I'm looking for where I think we're going to get more digestion and then start to roll over, but it does not look like it's going to happen until next year. So I've been really on that bent, right, since July, that this year, I still think make hay while the sun shines, right? SPX 6010 is still my high price target for this year. Semis, I'm still looking for a rotation for SMH to push up into 272. That's likely going to happen with NVIDIA, right? And it's likely going to be earnings in 3 weeks after we get through all the, FOMC and economic drama right now around the election. But for the most part, it's still going to happen. So it might be on pause. It might, have a quick rug pull and then go back in, but I still see higher levels before we start to digest into next year. And of course, I'll have to change if the conditions change. But for right now, even tomorrow, jobless claims and non-farm payroll coming in very likely disappoint because we had hurricanes and we had strikes. But that's going to be a temporary hit, disappointment, whereas it's not a sustainable economic drag, forecasted in. We've already had our GDP hit from net imports, exports that already shaved off 0.5%. We're going to have another 0.5% shaved off because of the economic impact from the hurricanes, and strikes. So this is part and parcel for temporary. Long story short, we really still have next year to deal with whatever POTUS we get. And as I always like to say, policies dictate price. So we really need to get that out of the way, whether it's red wave, blue wave, or somewhere in between. Market loves somewhere in between. We'll really have a better feel for next year. But I would also warn, last but not least, that advance that we have in NASDAQ right now that started in earnest January of 2023 is approaching 95% peak to trough, 92%. It's in that area. Just like we had with the 2000 high, it was literally peak to trough, 1999 through March of 2000 before we obviously fell over. But the point is, if we're going to hit that 100% by the end of the year, and I would not be surprised, right? Then we definitely have got to be a little reasonable in our expectations for New Year's to start. So outliers do revert. but we do need a macro trigger to interrupt. So in the meantime, enjoy the rest of earnings season. I have got two things, actually. One, we're doing a Halloween special. I think that starts tomorrow. You can LaDucTrading.com/Halloween. And yes, we have kind of an intro to options, and then we kind of elevate that through Hans. He's got fabulous mentorship programs, but also course material and a video course right now that we're offering on our website. So go to LaDucTrading.com and you'll find the email to sign up and get his video course, as well as a special offer through the weekend and Halloween. And I loved your Halloween analog right there that you said earlier, which is we're right now we're not scared away from the market yet. So collect all the treats you can while they're getting passed out.
That's right. Things are still sweet, but it could turn. It could turn.
Exactly. So thank you all for attending, and wish you a great rest of the earnings season. Cheers.
Subscribe to LaDuc Trading YouTube channel for more macro to micro options power hour and other content.